I remember when I first started out about 2.5, almost 3 years ago in mergers and acquisitions. And when I reached out to a investment banker, one of the things they asked me about was my investment thesis, right? I'm calling to these people, asking them to work with me, and I didn't know what an investment thesis was at the time. So I had to learn the hard way of how to create an investment thesis. So today we're going to talk about that. We're going to talk about what exactly is an investment thesis and why you need it when starting to buy seven-figure business. Let's go over here to Google. What does Google say an investment thesis is? An investment thesis is a written proposal or research-based analysis on why investors or companies should pursue an investment. In some cases, it may also serve as a historical guide as to whether the investment was a good move or not. Okay, so that is the definition of what an investment thesis is. So let's just talk about exactly how do you create your investment thesis when you're starting out, right? So first you have to define your investment strategy. You have to start by defining the overall strategy. What does that mean? When you decide that you want to start buying businesses or create an acquisition platform, you must determine if you are going to buy a lot of companies that are owned by mom and pops, which is fragmented. Are you going to buy a lot of these companies and put them together? If you are, that's a consolidation or a roll up. Or are you just going to buy any kind of company as long as it's profitable and it has great management? That's more of a conglomerate, right? You're industry agnostic is what that's called. Or are you going to buy something that's existing, has a foundation, and you're going to build upon that? The second thing you have to do is what are your investment themes? You have to identify your investment themes. This could be something that is overarching, kind of like microeconomic trend or macro on the bigger scale economic trends, or something that is heavily regulated. If you're in healthcare or you're looking at maybe you want to purchase oil refinery companies, these things are heavily regulated. Or you're looking at emerging technology, right? For example, if you're interested in a technology startup, you might want to look at AI, and then you want to look at cybersecurity and e-commerce. Number three, you have to have a set of investment criteria. And then there are some opportunities that you must meet. These criteria now typically, they include financial metrics, right? You have to have a team, a CPA or a investment banker, draw these financial projections for you so you know what the trajectory of the companies that you acquire in your company will be. What is the revenue and the EBITDA margin, right? And the valuation multiple. So these things are extremely important. Now you have to consider some non-financial aspects of it, like how you're going to grow the team, the management, your executives, and even lower management. You have to think about these things. And then lastly, right, you want to look at the quality of the management team. I mentioned that, the market position, right? And what kind of competitive advantage do you have? And then lastly, you have to look at your exit potential, because when you start looking at these businesses and you form you have your strategy of how you're going to grow, you must look at what your exit strategy is, meaning how you're going to get rid of it. Are you going to go via IPO, which is initial public offering? You're going public on a stock market, or are you going to do a private sale, right? So that's number three.
Let's follow up with number 4, which is market research. Now, there's a few ways you can go about this, but the most important way is just to start with an industry report. From a reputable source such as IBISWorld, you're able to get a full, detailed, comprehensive report of the industry. That would include your SWOT analysis, which stands for strengths, weaknesses, opportunities, and threats. But you're also able to look at the supply chain. How do these companies work with each other? Who's supplying who? And how you can structure these businesses. Another way you can conduct your market research is by analyzing larger companies in your industry. See what challenges they face. Every business has challenges. I mean, typically larger companies have overcome certain challenges, but you always see inefficiencies. This is where you could really pick up your value proposition. What are they leaving or not paying too much attention to? And that's where you could come in, so to speak. Moving forward into part 5 is you want to perform due diligence. Now, once you've picked up all your data, you want to verify the quality of this data, the accuracy of it. How can you do that? First of all, I think looking at public companies is a great way to do so. If you were to take a look at their financials, it will give you a better perspective, because these companies are already well ran and have a very large amount of smart individuals working for them. So if you see these companies operating at a certain profit margin or a certain expense rate, you can get an idea really of what the profitability of this industry or sector is. Again, industry reports, they typically share a lot of financial data, anywhere from forecasts. Is this industry in an upward trend for the coming years, or are they going to face any certain issues? I know when it was 2020, height of COVID, I was taking a look at IBIS reports because they were giving insights on how COVID was affecting the supply chain for these sectors, which made it very important. Let me share with you an example. For instance, I was looking at senior care homes. The problem with senior care homes at the time was that because seniors were more at risk, they had passed a legislation, or really it was a standby law where essentially we could not get any more seniors in these facilities because that would have increased the risk of transmission with them. So we were looking at businesses that were basically stagnant in growth in regards to the tenants or the amount of people we could have until further notice. And that became a risk for us to take on. So we disregarded that. So take a look at industry reports because they're typically up to date on what's currently happening with the world. Moving on to developing your thesis. Once you got your market research, you perform due diligence, you are able to verify accuracy and compile more additional data. This is where you lay it all out, anywhere from the macro to the micro. You know, this includes sectors, this includes companies as points of reference or comparables, this includes reviews, this includes, you know, notes you picked up from speaking with these industry experts and business owners. You lay it all out, and these are like pieces to a puzzle. Now you want to start putting the pieces together. How does this work? And I think the best way to visualize that is with a mind map. And we're going to put a picture example of ANSY's mind map, very in-depth and comprehensive. But once you start laying out a picture or a visual to how you're looking to approach this industry, what value you're looking to create, then you could really see if it makes sense or it doesn't. But then again, your knowledge is limited to a certain degree, so I would take this data. Hey, I put together my mind map, my research, my pitch deck, whatever it may be. Take it to your industry experts and have a strategy call. Hey, this is what I think so far about the industry based on my research. This is the points I see. These are the inefficiencies I see. These are the problems that a lot of customers face with these businesses. I think this is how we could approach this. What's your opinion? And then you can start talking about that. But moving on, we're going to be passing that to ANSY on the investment rationale.
You want to provide some evidence based on the market research that you've conducted, because at this stage here, you should have plenty of research, plenty of data and due diligence that you've done, you know, to back up exactly your investment rationale. You want to highlight specific value propositions, as Valentino mentioned, right? And all of these things is you want to show that you're aligned and you have identified great opportunities within that landscape that you're in, right? So you want to be very detailed when you're explaining this portion here. So that's going to be your investment rationale. Number 8, competitive analysis. I mean, that goes without saying. Competitive analysis, every company who's in business knows exactly what their competitors are doing. If they don't, unfortunately, they go out of business, right? So you have to study and know exactly who are your biggest competitors, where they are, what they're doing, and what is the proximity they have to you. What does that mean, right? I mean, obviously, you're not gonna go against any in Amazon if you're just a mom and pop, right? But you might want to look at the next 5 or 10 other similar businesses that has similar size to you in revenue and with respect to the services that they're offering. Look at those and look at exactly what they're doing and how close are you to them, right? Look at the prices and stuff like that. So you want to have a competitive analysis so you identify potential threats, right, and weaknesses that are in the market. And also you want to identify some gray areas as well. A lot of companies do really, really well when they operate in a gray area. What does that mean? You have a giant here, you know, you have some other giants there. They're occupying all of this space, but just right here, over here, is an area that they're not really in. Maybe it's a rural area, right, for one reason or another. They're not offering their services that widely to that demographic or that geographical location. And that could be something you could take advantage of and exploit. And a lot of companies have done well exploiting the gray areas in a market, right? So that's competitive analysis. And then you have risk assessment. Again, This goes without saying, but you want to assess the risk that's associated with your investment strategy. A lot of times people are extremely optimistic, but this is for new beginners and stuff like that, right? People who are a little bit more experienced, they tend to be a bit more conservative, you know? But what are the risks that are involved in your investment? I mean, are you going to go to the investor and say, well, there are 40,000 of these businesses, they're doing less than 5 million a year, and we're going to go and we can get 1% of the market share. If we control 1% of the market share, it's going to be this much, and we're going to have this success, this level of success. Well, okay, how can it fail? You know, what are the threats that are involved with doing something like this? Who's done something like this? And what company in that industry have gone out of business, right? So you want to look at all of these things and assess the risks that are involved, not just, hey, this can go, this is the upside, but what are the downsides to it? Number 10, we have exit strategy. Again, exit strategy is something that you want to have first and foremost. When I was acquiring real estate properties, Class A trophy assets for investors with the firm that I was with, a investment firm, the first thing that we looked at, even if we were not going to buy the property, the number one thing we had to know is how are we going to exit that, the disposition of that property, right? How are we going to get rid of this asset right here? Okay, before we acquire it, now are we buying it to hold for ourselves, or is this a strategic play that we're doing? We're going to get this asset and we're going to offload it to a investor that's looking for this type of asset. But how long is that going to take? And how are you going to get rid of it? What is the cost of it? The cost of doing that business? All of these things is included in your exit strategy. And you want to know the same thing when it comes to buying businesses. Okay, you're putting a great portfolio together, but who or what companies are most likely, when you get to a certain stage, those companies are most likely to buy you out? Or do you say, hey, look, this is a long-term play. I'm not interested in a private sale. I want to take this public because there's a lot of potential and we could actually impact the world a lot greater if we held on to this. And or maybe it's just something that you really, really have a passion for and you want to hold on long term. So you might want to do a different play, which is an IPO or a SPAC type of thing, which is a initial public offering or a special acquisition company, right? And that's something that's used for a public offering. So what is your exit strategy? And investors need to know this because you have different investors. Some of them, they invest long term, and some of them are like, look, I just have a 3-year, 5-year investment horizon. And after that, I want to check out. I want to get my money back plus my return. So you have to know your investors, who they are, and how are they aligned. Is it a long-term play or is it a short-term play? So exit strategy is extremely important. And then we have portfolio construction. What does that mean? Well, that just means, like myself, I'm buying medical practices, some medical labs, radiology, and all of these things, internal medicine. We can't just buy any internal medicine company practice or just any medical testing lab. It has to make sense. The reason why is because when we exit, we want to get rid of the entire portfolio. We're not looking to offload this subsidiary, that subsidiary, one by one, which some may argue that you would get a greater return if you do that. I do not agree with that. I want to offload the entire portfolio, and we have 3-4 companies that we know for a fact that they buy these kind of portfolios. So when we're constructing the portfolio, we want to make sure we're only buying companies that when we're ready to exit, have a really, really high chance of the buyer that we're looking at is going to buy the entire portfolio in its entirety, not maybe 80%, 70% here, and we're stuck with holding 30, 40% of a portfolio we no longer want. So keep that in mind. And that's actually the last point, number 11, portfolio construction. Valentino, any other points you want to make before we close this video out? Obviously, we want to tell them to, like the video, subscribe. And if you want to get this in a PDF format, go to ibuniversity.org/membership to get a PDF format. Valentino, let's end this.
Yeah, and lastly, guys, don't forget, you always start with an industry report. These cost thousands of dollars. So if you want something that's accessible, go to ibuniversity.org/membership and you can get a copy from us.